Hello and welcome, my brilliant CA inter-friends. Today, we're going to crack the code on a chapter that trips up so many students, the Foreign Exchange Management Act, or as we all know it, FEMA. And to see why, let's just jump straight into a classic exam trap.
Okay, take a look at this. You've got an Indian citizen, he works in Dubai, but he came to India for a visit and ended up staying for 190 days during the last financial year. So the question is he a resident under FEMA? Now, your first instinct, like pretty much every student, is to see 190 days, think, aha, that's more than 182, and confidently write down yes. And that, my friends, is exactly the trap.
And believe me, this is precisely where marks are lost. A massive number of students fall for this exact kind of question. But you know what? After this short explainer, you are going to be in that top 10% who get it right every single time. Let's make sure of it.
So how do we avoid that trap? Well, we have to understand the logic behind the law. Let's start right at the beginning. Why does FEMA even exist? Because you see, the rules for foreign exchange in India used to be very, very different. This timeline here, it tells a really fascinating story. You see, before 1991, India was under a very strict law called FERA. And the key word there was regulation. It was a tough, controlling law, and any violation was treated almost like a criminal offense. But then, after the economic liberalization in 1991, India was opening up to the world and needed a new law to match. So in the year 2000, we got FEMA, and the entire philosophy shifted from strict regulation to flexible management. And you can see this change perfectly in its preamble. The goal of FEMA isn't to catch you or restrict you, it's to make things easier. It's there to facilitate external trade and promote an orderly foreign exchange market. The entire vibe of the law is positive and enabling. So remember this, FEMA is a facilitator, not a regulator. It's here to help, not to hinder. Okay, so with that why in our minds, let's now look at the how, the basic ground rules that give the Act its structure. So the Act applies to the whole of India. No surprise there. But here it is, your first big ICI trap alert. Get your highlighters ready for this second point. FEMA also applies to branches and offices outside India, but only if they are owned or controlled by a person resident in India. So if an Indian resident controls an office in London, guess what? FEMA applies to that London office. This extraterritorial reach is a favorite area for ICI to test you on.
So how is this whole thing structured? It's pretty simple actually. At the top, you have the main act, passed by Parliament. Then you have the central government, specifically the Ministry of Finance, which makes the rules. And under that, the big boss of foreign exchange, the RBI, issues regulations. And who enforces all this? That's the job of the Directorate of Enforcement. Just remember this hierarchy. Act, then rules, then regulations. It's absolutely fundamental.
Okay, now we're getting to the heart of FEMA, the definitions. If you can master these key terms, I promise you'll be able to solve any practical question that comes your way.
First things first, what even is foreign exchange? It's not just the cash, the dollars or pounds in your wallet. The definition is incredibly broad. I mean, think about it. A deposit you have in a foreign bank, a draft you draw in rupees but is payable in dollars, or even a draft from a foreign bank that's payable right here in rupees, all of it, every single one of those things is considered foreign exchange. The scope is massive.
And who can you deal with for all these transactions? Well, only an authorized person. And that's basically anyone the RBI has given a license to. So we're talking about your banks, the money changers you see at the airport, those are all authorized persons. You can't just exchange foreign currency with your friend, it has to go through one of these official channels.
Now, this slide is absolutely critical. The difference between a current and a capital account transaction is where so many marks are made or lost. Here's the core difference. A capital account transaction alters your assets or liabilities. Think of it like this. If you buy a house abroad, your assets have changed, right? That's a capital transaction. But if you're just paying for your kids' college fees abroad, that's a current account transaction. It's an expense, it doesn't really change your balance sheet. And notice the legal approach here. Current account deals are generally permitted, while capital ones are generally restricted unless there's specific permission.
So all these rules we're talking about, they apply to a person. But who exactly is a person in the eyes of FEMA? This definition is the foundation for absolutely everything that follows. As you can see, the definition is pretty wide. It includes an individual, an HUF, a company, a firm, the usual suspects. But hang on, look at that last point. This is the crucial one. It also includes any agency, office, or branch that is owned or controlled by any of those people. And this is so important because it links directly into our next and most vital definition. All right, team, take a deep breath. This is it. This is the single most tested, most twisted, and most important part of the entire chapter, residential status. If you can master this, you've pretty much mastered FEMA. Let's do this.
Look, let's just simplify this whole thing. For an individual, it's a two-step process. Do not jump to conclusions. Step 1 is the basic days test. Did they stay in India for more than 182 days in the preceding financial year? If the answer is yes, then and only then do you move to step 2. If the answer is no, stop right there. They're not a resident. Simple. Step 2 is the game changer. You have to check for exclusions. This is where the magic really happens.
And here are those exclusions. Look very closely. For a person who has gone out of India for a job or business or for an uncertain stay, they are not a resident, even if they were here for more than 182 days. But now look at a person who has come to India. The wording is flipped. They are not a resident if they came to India otherwise than for those purposes. What does that mean? It means if they came to India for tourism or to visit family, they are not residents, no matter how many days they stayed. I'm telling you, ICAI loves to twist this otherwise than phrase. So what determines if someone falls into an exclusion? It's all about their intention, which is judged by these 3 purposes. Are they here for a job, for business, or for some other reason that suggests they plan to stick around for an uncertain, long period? The purpose of their stay is way more important than just counting the number of days. And just to complete the picture, remember, it's not just about individuals. Any company incorporated in India is automatically a resident. An office that's in India, even if it's owned by a foreign company, is considered a resident. And, like we talked about earlier, an office outside India, if it's owned by an Indian resident, is also considered a person resident in India for the purposes of this act.
Okay, time to solve the mystery. Let's go back to our original question. Indian citizen, works in Dubai, was in India for 190 days last year. Let's apply our foolproof 2-step process and see what happens.
And the answer is he is not a resident. So why? Let's break it down. Step 1, was he in India for more than 182 days? Yes, he was here for 190. So we move to step 2. Now we check for exclusions. Is this a person who has gone out of India for employment? Yes, he works in Dubai. That purpose, employment outside India, puts him squarely in the exclusion category. So even though he met the day count, his purpose overrides it. He is a non-resident. See? It's so simple when you just follow the steps.
So, the crucial takeaway, the one thing you should write down in big, bold letters, is this. Under FEMA, the number of days you're physically present is just the starting point. It's your intention, your purpose of stay, that truly defines your residential status. Don't you ever forget that. Current account transactions. We're going to break down all the key rules, the exceptions you have to know, and of course, the common traps that ICAI just loves to set. My goal is to make sure you walk into that exam feeling confident. So, let's dive in. Okay, picture this exam scenario. Your buddy, who lives and works in Dubai, gives you a call. He says, "Hey, can you do me a small favor? Just pay my LIC premium here in India. I'll send you the money later." I mean, it sounds totally harmless, doesn't it? It's just helping out a friend. But let me tell you, in the world of FEMA, this is exactly the kind of question where easy marks just vanish.
And the answer is wrong. A big, fat no. This is absolutely a violation. That seemingly innocent favor, it's a direct breach of Section 3B of FEMA. Why? Because it prohibits you from making payments in India for the credit of a person who is resident outside India. This is the perfect example of a practical trap ICAI loves. It just goes to show you can't just memorize the theory. You've got to understand how it applies in real life. So before we can even get into the transactions, we have to nail down the very first trap that so many students fall into. Figuring out who is a person resident in India, or a PRI. You might be thinking, oh, that's easy, it's the 182-day rule. But as you're about to see, it's not always that simple.
Let's take a look at this classic ICAI-style case study. Meet Miss Alia. She's an air hostess with British Airways, and for security reasons, she's based out of Mumbai. Now, over the course of the financial year, she ends up staying in Mumbai for well over 182 days. So just based on the day count, you'd probably say, yep, she's a resident. But is she, really? The answer is no. And this is a brilliant illustration of a crucial point you cannot forget. Under FEMA, intention is king. It matters more than just the number of days. See, Miss Alia didn't come to India for a job here or for some reason that implied she was planning to stay indefinitely. She was here because her employer put her here. So the takeaway is this.
Even if someone crosses 182 days, if their intention was never to stay for an uncertain period, they are not a resident. Remember that twist.
Okay, so now that we're clear on who's a resident and who's not, let's move on to Section 3. I want you to think of this section as the big, powerful gatekeeper of FEMA. It basically lays down a blanket restriction on who you can deal with and how you can send or receive money when foreign exchange is involved.
So Section 3 lays down 4 fundamental prohibitions. These are the big no-nos. First, you can only deal in foreign exchange with an authorized person. Think banks. Second, you can't make a payment in India to a non-resident. That was our insurance premium example. Third, you can't receive a payment on behalf of a non-resident unless it's coming through the proper banking channels. And finally, number 4, it completely bans any hawala transactions. All of these are totally off limits unless you get specific permission from the RBI. Now, that third point, receiving payment, has a really tricky explanation you've got to watch out for. It basically says that if you receive money in Indian rupees for a non-resident, but there's no matching foreign currency coming into India, it's a violation. This is how FEMA plugs a massive loophole, right? It prevents these backdoor money movements that try to bypass the official banking system.
Great. Now let's move on to Section 4 and see how the rules build on each other. This section is all about what a resident of India can hold outside the country. And let me tell you, the default rule is simple and very restrictive.
The law here is super strict. A person resident in India generally cannot acquire or hold foreign assets. So for example, if your uncle in London gives you $10,000 that are sitting in his UK bank account, you can't just leave it there. You are required by law to bring those funds back to India. The default rule is crystal clear. Unless you have specific permission to hold it, you have to bring it home.
Okay, deep breath, because we are now at the absolute heart of FEMA, the distinction between a current account transaction and a capital account transaction. I'm not exaggerating when I say if you understand this one concept, you understand the entire logic of the act. So many marks are lost right here if you get this wrong.
Here is the absolute simplest way to think about it. A current account transaction. It's like an item in your profit and loss account. It's for day-to-day stuff, revenue-type things. Think imports, exports, paying interest, sending money to your family abroad. Once the transaction is done, it's over. Crucially, it does not change your long-term assets or liabilities outside India. A capital account transaction, on the other hand, is like a balance sheet item. It fundamentally alters your assets or liabilities outside India, like buying property abroad or investing in foreign stocks.
And this distinction leads us to the golden rule of FEMA. You have got to memorize this. For current account transactions, they are freely allowed, unless they are specifically restricted. The government has to tell you what you can't do. But for capital account transactions, it's the total opposite. They are prohibited by default, unless they are specifically permitted. The government has to tell you what you can do. This difference in approach is literally everything in FEMA.
So you might be asking, how do we know which current account transactions are restricted? Well, the answer lies in 3 absolutely critical schedules. I want you to think of these schedules as the final verdict from the government telling you exactly what's what.
First up, we have Schedule I. These are the prohibited transactions. And when I say prohibited, I mean completely and utterly banned. There's no approval process, no workaround, nothing. You just cannot remit foreign exchange for these things. This list includes stuff like sending lottery winnings abroad, paying for banned magazines, or certain very specific types of export commissions. It is a hard stop, no exceptions.
Next up, we have Schedule II. Now, these transactions aren't banned outright like in Schedule I, but they're not freely permitted either. To do any of these, you need to get prior approval from a specific ministry of the central government. And just look at the level of detail here. For cultural tours, you need approval from the Ministry of Human Resources. For a public sector undertaking's freight charges, it's the Ministry of Surface Transport. Now, you don't need to memorize this entire table word for word, but you definitely need to be familiar with the concept and know a few key examples. This is prime material for MCQs. And finally, we get to Schedule III, which, for most practical purposes, is the most important one. These transactions are generally permitted, but they are subject to certain limits, primarily under what's called the Liberalized Remittance Scheme, or LRS. And here it is, the magic number you absolutely, positively must burn into your memory. The LRS limit for resident individuals is $250,000 US. That's per person, per financial year. This single limit covers a huge range of both current and even some capital account transactions.
So under this $250,000 umbrella, an individual can send money for all sorts of things: private travel, gifts to relatives, supporting family abroad, medical treatment, university fees, you name it. As long as you stay within that limit for the whole financial year, you generally don't need any special RBI approval. If you need to send more than that, well, then you have to approach the RBI.
But, and listen up, because this is a massive exam tip, ICAI absolutely loves this exception. For three very specific purposes, we're talking emigration, medical treatment, and studies abroad, you can exceed the $250,000 limit without prior RBI approval. The catch? You need to have the estimates from the foreign university or the hospital to prove that the required amount is genuinely higher. This is a very, very important point. Don't forget it.
Now, what about entities like companies? Well, for them, the rules are different. They don't just have a simple LRS limit. Instead, they need to get prior RBI approval once they cross very specific thresholds for certain transactions. For instance, a donation can't go above 1% of their Forex earnings, or a commission on selling a property can't be more than $25,000 or 5%, whichever is higher. You need to pay close attention to these specific limits because they are absolutely perfect for case study questions. Okay, we're almost there. Let's finish up by covering the exemptions. Look, knowing the rules is one thing, but knowing when those rules don't apply, that's what separates a good answer from a great one. And this often comes down to a couple of special bank accounts.
This is where these special accounts become so powerful. If you're making a payment from a resident foreign currency or RFC account, you are completely exempt. You don't need any approval for Schedule 2 or Schedule 3 transactions. Simple. Now, an exchange earner's foreign currency or EEFC account gives you almost the same amazing exception, but with three very specific exceptions where you still need approval. And you have to watch out for these: certain club membership fees, those high property sales commissions, and pre-incorporation expenses. It is a subtle but absolutely critical detail for your exam.
All right, let's tackle a topic that is absolutely critical for your ICAI exams. But let's be honest, can be a bit of a headache: capital account transactions under FEMA. If we can get these rules straight in our heads, you're not just learning theory, you're basically guaranteeing yourself some solid marks. So let's get this done. So picture this for a second. An Indian resident sends money abroad for their kids' education, they buy a small apartment, invest in a few shares, pay for their parents' medical bills, and then give a loan to a cousin living overseas. It all sounds pretty normal, right? Well, under FEMA, one or maybe even more of those transactions could be a huge problem. Stick with me, and by the end of this, you'll know exactly which ones are tricky and, more importantly, why. First things first, what on earth are we even talking about here? We have to get this foundation right because, trust me, if you don't nail the definition, the rest of this chapter is just going to be confusing. Okay, I know that sounds like a mouthful of legal text, but don't let it scare you. It's actually way simpler than it sounds. Think of it like this: a capital account transaction is any deal that changes what you own or what you owe across India's borders. So if you live in India and you do something that changes your assets or liabilities outside India, that's a capital account transaction. And it works the other way too. If someone lives outside India and their assets or liabilities inside India change, yep, that's also a capital account transaction. It's all about that cross-border shift in your balance sheet. And this image shows that flow perfectly. You've got your person resident in India, or PRI, on one side, and the person resident outside India, or PROI, on the other. Anytime a deal forges a link between them that changes their assets or liabilities, like our PRI buying a house abroad, or a PROI investing in an Indian company, boom, we are playing by capital account rules. Now, this slide here is super important. Why? Because it's about a critical amendment, and you know how ICAI loves testing those. Since October 15th, 2019, the power to make these rules is split. The RBI, the Reserve Bank of India, they're in charge of anything related to debt instruments. So think loans, bonds, all that stuff. But the central government, they handle the non-debt instruments. We're talking equity, shares, property. You've got to remember this date and this division. It's a very likely exam question. And here's one of those crucial exceptions where you can easily lose marks if you're not careful. Think of these as protected payments. Even though the government and RBI can set a lot of rules, there are two things they cannot stop you from doing. First, drawing foreign currency to pay back your foreign loans. You know, the principal and interest payments, or amortization. And second, for the depreciation of your direct investments abroad. FEMA makes sure these normal, essential business payments are always allowed. Okay, let's move on to our next section, which deals with a very specific but common situation. What happens when your residency status changes? Say you were a non-resident, but now you're a resident. Or maybe the other way around. What about all the assets you bought back then? This slide nails it. Section 6.4 is for the person who becomes a person resident in India, a PRI. It basically says, hey, any foreign currency, securities, or property you got when you were a non-resident, you can keep it. You can hold it, own it, transfer it, whatever. Section 6.5 is just the mirror image. If you become a person resident outside India, a PROI, you get to keep all the Indian assets you acquired when you were a resident here. It's a you can keep what you had rule. Makes sense, right? And the RBI made this even clearer, giving people returning to India a lot of freedom. So that foreign bank account you opened while you were working abroad, you can keep it. The money you earned over there, it's yours to hold. If you inherited some assets from another non-resident, that's fine too. And here's the real kicker for case studies. You can take those existing foreign assets and freely use them to make new investments abroad without having to go back to the RBI for fresh permission. Okay, so we know what these transactions are and who makes the rules. Now for the really practical part. What are you actually allowed to do? Let's start with the official list for Indian residents, which you'll find in Schedule I. So here's the first part of the checklist for someone living in India. You can, of course, invest in foreign stocks and bonds. You're also allowed to raise loans in foreign currency. When it comes to property, transferring immovable property outside India is on the list. You can also give guarantees for non-residents. And finally, even the physical movement of currency notes in and out of the country is covered here. And the list continues. You're also allowed to borrow from someone outside India, keep foreign currency accounts, and even get an insurance policy from a foreign company. And notice, it goes both ways. You can also give loans to a non-resident. Finally, sending your capital assets out of India and getting into derivative contracts are also on the permissible list in Schedule I. All right, let's flip the coin. What can someone who lives outside India do in India? This is all about money coming into the country, and it's covered under Schedule II. So, for a non-resident, the rules are all about their activities inside India. Of course, they can invest here, whether that's buying securities or putting capital into a business. They can also buy and sell immovable property, though there are some specific rules for that. They can give a guarantee for a resident here, and just like residents, they can also manage the physical import and export of currency. And to finish the list for non-residents, they can manage deposits with residents and open foreign currency accounts here in India. Now, this next one is really important. They are allowed to remit their capital assets. That means they can take the money they've made from their Indian investments and send it back home. And just like residents, they're also allowed to get into derivative contracts. All right, everyone, I need your full attention now. This is the section where I'm telling you most students lose marks in the exam. We've talked about what's allowed. Now let's get into the hard stops, the things you absolutely cannot do, and the strict money limits you can't cross. This number, you have to burn it into your brain, $250,000 US. This is the magic number under the Liberalized Remittance Scheme, or LRS. It's the maximum amount a resident individual can send abroad in one financial year for all those things on the permissible list, without needing to get special permission from the RBI. But you know it's never just about the number, right? The conditions are just as important. First, that $250,000 is a combined total for both current and capital account stuff. Second, if there's a specific rule for a certain transaction that lets you send more, then you can go with that higher limit. And this last one is absolutely crucial. You cannot, under any circumstances, use this LRS money to send funds to countries on the Financial Action Task Force, or FATF, blacklist. That's a huge no-no. This is a classic theory question just waiting for you in the exam. Where can non-residents not invest their money? The list is very specific, so let's lock it in. No chit funds or needy companies. Those are local finance bodies. No land-based stuff like farming or plantations. No speculative real estate business or building farmhouses. And finally, no trading in what's called transferable development rights, or TDRs. You have to know this list. And here it is, the classic ICAI trap. The last slide said real estate business is a no-go, but what does that term not include? Well, it doesn't include big development projects like building whole townships or constructing residential and commercial buildings. It also doesn't include building roads or bridges or investing in regulated real estate investment trusts, or REITs. You see, these are about development, not just buying and selling land for a quick profit, so they are allowed. I can almost guarantee ICAI will test you on this exact difference. Lastly, there's a very strict country-specific ban. Because of international sanctions, any and all capital account transactions with anyone from North Korea are completely forbidden, unless you get prior approval from the central government. The rules were so tight, in fact, that anyone with existing investments there had to get rid of them within 180 days. This is an absolute red line you cannot cross. Whew, okay, we have covered a lot of detail. So let's zoom out and boil all of this down to the key things you absolutely need to remember for your exam. Think of this as your final, high-speed revision checklist. So let's tie it all together. Here's the core logic of FEMA in a nutshell. First, the golden rule. Current account transactions are basically free, while capital account transactions are basically restricted, unless they're specifically allowed. For the ones that are allowed, remember that power split. RBI for debt, central government for non-debt. And your final safety check is always the two lists. If a deal is on Schedule I for a resident or Schedule II for a non-resident, you're probably okay. Just watch the limits. If it's not on either list, you're going to need special permission. So let's end with the one question that will solve almost every case study you get on this. When you see any transaction that crosses India's borders, the very first question you have to ask yourself is this. Is this transaction on the permissible list in Schedule I or Schedule II? If you start right there, you have the key to unlock the entire problem. Master that approach, and you've mastered capital account transactions. All the best.